next guest says a double-dip recession could be on the horizon. Kapstream Capital Managing Director and founder Kumar Palghat joins us now. Good to see you there. It does seem to many to be a very extraordinary way to run the world's biggest economy, but it may well be teetering on the edge of recession, as you may be thinking.
Yeah, look, as you mentioned earlier, this is by them not passing the Super 12, not coming up with cuts in the deficit, automatically forces the U.S. in 2013 to reduce the deficit by 1.2 trillion. Now you're at a situation where you probably don't want to cut spending because the economy is not doing very well and the Fed's done everything that they can. So on top of that, if you take 1.2 trillion in spending away and cut the deficits, growth's got to slow down. So yeah, the U.S. faces a double dip, not in 2012, maybe in 2013.
Yes, but also it just adds to this feeling well, chaos, really, as far as political leaders, not just in Washington, but also in Europe. What effect is that having on the markets, and what effect is it having on your business?
No, it's extremely difficult to trade the markets because the longest term view that you could have is probably a 4-hour view. And partly it's driven by politicians, right? I mean, as you just mentioned, Europe needs to either, I read a great line, it said print or perish. They have to at some point give confidence to the market, saying that if you do buy the peripheral debt, that you're going to get your money back and it's going to be back in euro. Because you don't know, no one wants to buy. It doesn't matter if the yield is 7 or 8 or 9%. No one's going to step in to buy because no one knows.
And well, S&P says it'll keep the U.S. government's credit rating at AA+. No such guarantees, however, for France. The French 10-year yield, what, 3.4%? Is a downgrade there inevitable, and what effect will that have?
Well, it's like a domino effect in Europe. What you're seeing is, you know, after Greece it was Portugal, Ireland, Spain, now it's France, and you know, people are going to be watching whether the French government can maintain its rating. It's not 3.5%, soon it'll be 5%. Ultimately, you need to have a stopgap measure that lowers bond yields or borrowing costs. If you just purely look at sovereign borrowing that's going to come in 2012, you've got Europe borrowing about 1.5 trillion, US at 2, and Japan at 2.5. If you add the banks, there's an enormous amount of debt that needs to get financed in 2012, and the politicians better get their act together so that investors can get some confidence they can buy this debt.
Yeah, but the politicians are not getting their act together so far. Does it land, therefore, on the ECB to step in and change its modus operandi?
I think so. I think at some point the ECB needs to do what the Fed is doing. So why hasn't U.S. rates sold off? That's because you've got the Fed as the backstop, and since the S&P downgraded the U.S. in August, U.S. Treasury yields have actually dropped. Okay, granted, the equity markets lost about $10 trillion in value, but the U.S. bonds haven't sold off because you've got the Fed there buying Treasuries. Similarly, in Europe, if you don't want the European peripheral spreads to widen, you need to have either the ECB or you need to have some form of guarantee from the European Union that they would buy these debt. That's the only way to reduce the cost of borrowing. So, yeah, they've got to do something.
Given what's happening in Europe, given what's happening in China, slowing down, and also in America, how is that affecting your investment strategies? Are you completely defensive here? How much of it is kept in cash, for a start, in your portfolio?
No, we've been very defensive. You know, during the global financial crisis, our fund had about 60% cash. Today we have about 30% cash. I wish my cash holdings was a lot higher. But having said that, there are some incredible assets, good yielding debt assets that you can buy. But the problem is timing. The liquidity in the markets is drying up and volatility is extremely high. And being in Sydney, I think the problem is that Asia in general has got a positive economic story, but Europe is dragging Asia down, and the U.S. politics not helping either.
You have said that Europe needs, what, a financial Botox. What did you just mean by that?
Well, what Europe really needs is somehow for the central bank and the governments to give confidence back to the markets. We're not saying it's a permanent fix. All we're saying is you need somehow to put lipstick on the pig, I guess, to make it look a lot better. You need to lower the cost of borrowing, and the only way you can do that is to give confidence. And the only way you can give confidence is to have a backstop somehow, either from Germany or the ECB or the IMF, and the number's got to be 1 to 1.5 trillion. It can't be a few hundreds of billions of dollars, because we know there's more debt coming.
Kumar Palghat, Kapstream Capital, MD and founder. I'm grateful to you. Thanks very much.